Very good evening all of you. Can you please confirm if my audio video is clear and the screen is properly visible to everyone? Please confirm, guys. Is my audio and video clear to everyone? Is my audio and video clear? Please confirm. Perfect. Thanks Arun. Thanks Arun for the confirmation. Now, I believe your studies are going good so far. So let's start the series or the season finale, the last day of the revision series. So I believe we have discussed all the important chapters, and today also we'll discuss the remaining important chapters, that is financial instruments, advanced performance measurements, and the framework as well. Though we'll discuss the framework in very briefly, okay, and I'll give you the guidance on how you have to study, okay. Now, also there will be few chapters, guys, a few chapters which I'll give you the guidance for which we'll not be covering in this session. But yes, we have already covered that in our FR session, okay. So that will give you the overall understanding of the concepts. So I don't want to do duplicacy, okay. So I will give you the link also. I will give everything, all the information I'll give at the end of the session. Don't worry, don't worry. Now, okay. So if you are unable to comment, in the live chats, please subscribe to the channel because we have opened that option. If you are not a subscriber, you will not be able to comment. Now, so let's start the topic, that is the financial instruments. The financial instruments. Understand, guys? This is topic 1 for the day. Financial instruments. Understand what is the meaning of the term financial instruments first. What is the meaning of the term financial instruments? So understand, standard says that any contract between two or more parties, okay, which gives financial asset for one party, and a financial liability or an equity instrument for another party. Let me give an example. Let's suppose Reliance issues equity share capital. So now, so it's an equity for Reliance, but let's suppose I as an investor purchased it, okay. So for me it's a financial asset. Now let's suppose Infosys takes a loan from the bank. For the bank it's a financial asset, but for Infosys it might be a financial liability, right? So for one party it will always be financial asset, and for another party it will always be either financial liability or equity, okay. Now comes the question, how will we analyze whether it's a financial liability or equity? So for that, welcome to the standard of financial instruments. Unlike what used to happen previously, that if the name is equity, I'll say it is equity share capital. If the name is loan, I'll say it is a liability. No, this doesn't happen that way now, okay. This doesn't happen this way now. So basically we focus more on the substance of the contract rather than on the form of the contract. So just come to the standard and discuss it off. Now, what is the meaning of financial liability? So standard says financial liability is a contractual obligation. It's a contractual obligation. Obligation means I am bound. Understand? I am bound. Obligation means I am bound to pay. Okay. To deliver either cash or any other financial assets. Let's suppose I have taken a loan. Don't you think I am contractually bound by that loan agreement that I have to deliver or I have to repay the money, right? That's a financial liability. Or to exchange financial asset or financial liability under potentially unfavorable conditions, not favorable, it will be unfavorable conditions, potentially unfavorable conditions. Let's suppose I entered into a bet with Siddhant that Siddhant, it will not rain today, okay, it will not rain today. Let's suppose it rains, then I have to give a certain amount of money to Siddhant, right? So that's a potentially unfavorable condition for me, right? In which I have to exchange, or in which I have to give him my financial assets, and I'm contractually bound by that, right? I'm contractually bound, assuming that me and Siddhant has a contractual obligation, has a contract in place, right? So I have a contractual obligation. And Siddhant has a contractual right. So for me it's a financial liability, and for Siddhant it's a financial asset. Okay. Now, contract that will be settled in an equity entity's own equity instruments, which are variable in number. Why I'm saying variable, guys? Why I'm saying variable? Because if it is fixed, it will become equity. Okay. If any instrument is convertible into or is settled into fixed number of equity shares, that is called equity. To give an example, let's suppose I have entered into a contract with Arun to deliver him 1000 equity shares of my company after 1 year. This is called a share warrant. And what is it called as? It's a part of equity, right? It's a part of equity. So now what is equity? Equity is the residual interest in the net assets of the entity after paying all its liabilities. Now again, see guys, I'm just trying to link these two definitions now. Understand? To deliver equity instruments of own company which will be settled in fixed number. So if it is fixed number, it becomes equity. If it is variable number, it becomes my liability. Is it clear, everyone? If any instrument has to be settled in fixed number of equity instruments, that becomes equity, and if it has to be settled in variable number of equity instruments, it becomes financial liability. Understand, guys? Understand? Let's suppose I say to Siddhant, I've taken a loan from Siddhant of rupees 10 lakhs. Okay, Siddhant, I've taken a loan of $1 million. I've taken a loan of $1 million from you. Okay. Now for 1 year, so I can repay $1 million to you. Or I can say that, Siddhant, I will give you the shares of my company. Then you will ask, sir, how many shares will give me? Then I'll say Siddhant, what I'll do is after 1 year, whatever is the price of my share, I will divide that by adjust that by 1 million, and whatever number of shares comes, I will give you that number of shares. So that if you want 1 million, if you want cash, you can sell those shares in the market and take cash. So don't you think whenever the equity shares are given variable in number, then the equity share just becomes a mode of currency. It's not the substance of the contract, but rather it becomes a mode of currency. So whenever any contract has to be settled in equity instruments, own equity instruments, and that equity instrument is variable in nature, variable in number, then it becomes financial liability. If it is fixed in number, it becomes equity. Okay, now what is the difference between liability and equity? Understand, guys, liability is unavoidable, but equity is avoidable. It's at the discretion of the company. Now understand, guys. Let's suppose I started my own business. I took $1 million loan from the bank, and I invested my also $1 million. Okay, I have done job for so many years in the past, so I had few savings. So what I did, I invested $1 million in the business that I started, and $1 million I took the loan also. So total becomes $2 million. After let's suppose 6 months. After 6 months, I think that no, this business is not going to work. I want to shut down the business, and in hand I have cash of only, let's suppose, $1.8 million. In hand I have only $1.8 million. Tell me, what will I do first? From that 1.8, I'll have to pay first to the bank. That is the loan that I've taken from the bank, right? And whatever remains will pay to equity, right? That is me. I am the equity holder, right? Whatever remains, I'll take back, right? So now understand, guys. Understand. So liability is unavoidable. Equity can be avoidable. Is it clear, everyone? Is it clear, everyone? Now understand, guys, there are certain instruments in the market, having the features of both equity and liability, Now, so those are called as compound financial instruments. Any instrument having the feature of both equity and liability are called as compound financial instrument. Okay. Now comes the question, how to do the accounting for that? The standard says that whenever any instrument has the features of both equity and liability, so on the date of issue of the instrument, I will break the instrument into two parts. And this process of breaking the instrument into two parts is called as split accounting. Okay. Now, how do we do split accounting? See, it says that identify that in the contract, what are your contractual cash flows? Means the cash flows which you cannot avoid, which are an obligation for you, means which are unavoidable. Now, calculate the contractual cash flows which are unavoidable, or identify the contractual cash flows which are unavoidable. Then, calculate the present value of those cash flows using the market rate of similar instruments without conversion rights. Using the market rate of similar instruments without conversion rights. I use as a query in SPP also we have instruments which can be either equity or cash or mix of both. What are the key difference between them and FL? I used to understand there is no difference. And I believe in SBP when I was saying that whenever any options are issued to the vendor with settlement alternative, okay, we apply the principles of this one, compound financial instrument, right? I use in our day 3, recall day 3 or day 2, I believe it was, when I discussed the share based payments, right? I told that it applies the principles of financial instruments, compound financial instruments. Okay. Now, so I calculate the present value. See, understand? I'll link both of them. Don't worry, I'll link both of them. Okay. Now, whatever is the proceeds of instrument minus the financial liability is my equity. So residual portion is my equity. Understand? So it says first calculate the value of liability, calculate the value of liability, and recognize that full amount as liability. Ayush, tell me, is this what we did there as well? We first calculate the whole amount of liability. And we told that this is whatever is the amount of liability, this is wholly liability. Then whatever remains is my equity. Is this what we did there also? Whatever remains, the balancing figure was equity. Tell me, Ayush, is this what we did there? So the principles of share based payments with settlement alternative is the same as this one. Okay, is the same as this one. Now understand what happens. We need to understand two things. How to identify contractual cash flows? In a compound financial instrument? Okay, and why do we need to take market rate? Understand, guys. See, whenever there is any compound financial instrument, guys, please pay 100% attention here. This is a very, very important topic. Okay, please pay attention here, all of you. Whenever there is any compound financial instrument, that compound financial instrument can have three components. Okay, it cannot have any other component. It cannot have any other component apart from these three, any other component. Okay, now first component is the principal money that you have paid, the principal money. Second component is either the interest or the dividend, either the interest or the dividend. And the third component is conversion rights. The third component is conversion rights. Now, standard says that conversion rights will always be equity. Why? Conversion rights will always be equity. Will always be equity. Will always be equity. Why? Because standard says that this conversion rights gives the instrument holder a right to convert the instrument to equity. Hence, this will always be equity. We don't need to assess also. We don't need to assess also. Now, interest or dividend. See guys, in the past we used to say that okay, if it is an interest, it's a contractual obligation. If it's a dividend, it's not a contractual obligation, rather it's payable at the discretion of the company. Agree with you. But there can be a case that the dividends can also be contractual obligation. Let me give you an example. Cumulative preference shares issued by the company. Cumulative preference shares. Wonderful answer, Ayush. Wonderful answer. Cumulative preference shares. Okay. Cumulative preference shares. Okay. It can be the case that the dividend is a contractual obligation in that case, right? So just because the name is dividend, we cannot say that it is payable at the discretion of the company. No, we have to analyze whether it is an interest or dividend. Whether it's an interest or dividend. It can be the case that the interest is not a contractual obligation. Why? We will pay interest when the company wants to pay. See, I'll tell you. When me and Ayush have to enter into any contract, Ayush, let's suppose I and you, I will enter into any contract with you. Will I see what is said in the standard, or I will see we will enter into a contract with according to our benefit? Tell me. We can enter into any contract with any terms and conditions, right? We will not go and see what the standard says for this, right? Standard is just for the accounting. Standard is for the accounting, right? Of what we have done. Rather, it's not the other way around. It's not the other way around. When we are doing the accounting, we'll not see the accounting, right? When we are doing the transaction, we'll not see the accounting, right? So let's suppose I have entered into transaction with Ayush, wherein Ayush will give me money and I will have to pay him the interest whenever I want to. Ayush said that, sir, if you want to pay interest, you can pay interest. If you don't want to pay interest, don't pay interest. So don't you think in this case interest is payable at my discretion? Interest is payable at my discretion, right? So now in this case I can say that there is no contractual obligation, and if there is no contractual obligation, that's an equity. Okay, if there is a contractual obligation, then we can say it's a financial liability. Example of instrument where interest is not the obligation. Aditya, that's what I said right now. That I have entered into a contract with Ayush, wherein we have contracted that I will not be required to pay interest to him. Okay. So contract can be anything. Can be anything. Now coming to principal. See the principal. How will the principal be settled? Understand? One way of settlement of principal is to pay in cash or any other financial asset. One way of settlement is to pay in cash or any other financial asset. So don't you think that's a financial obligation, and hence it is a financial liability. Hence it is a financial liability. Please confirm. Please ignore these 2 points. Please ignore last 2 points. But tell me only this point. Only this point. Is it clear, everyone? Is this point clear? Is this point clear? Whenever whenever I have to settle the principal by payment in cash or any other financial asset, don't you think I am contractually bound? Right? So it will be FL. Now comes another thing. The principal will be convertible to equity. Will be converted to equity. So now if the equity, now let me see who can answer it correctly. Now if it is convertible to equity, and equity is variable in number, tell me what it will be called as, equity or financial liability? It is converted to equity. It is convertible to equity. Tell me. It will be called as what? It will be called as financial liability. It will be called as financial liability. Why? Because it is variable in number. It is variable in number, right? Now, if it is convertible to equity and the number is also fixed, now we have to assess again three things. Again, we will have to assess three things. Neha, compound. How come compound? This instrument wholly is compound. This instrument wholly is compound. For a compound instrument, we are discussing things. Okay. Now, if it is convertible to equity and it is fixed in number, convertible to fixed equity numbers, so then I'll say whether it is optionally convertible. Optionally convertible means, see, I'll tell you. I took a loan from Ayush. I took a loan from you of 100,000 loan I took from you, and I told that Ayush, when I will repay this loan, what I'll do is I will give you 1,000 equity shares of my company, or I can give you cash, whatever you want. Okay, I am giving the option to you. I am giving the option to you. Whatever you want, I will do it. Tell me, after, let's suppose this is for 1 year. After 1 year, Ayush, you come to me and say that, sir, I need cash. Ayush, can I deny? Can I deny? No, I will give you equity shares only. Can I say that? Can I say that, Ayush? No, right? So it means I do have a contractual obligation, right? So whenever it is optionally convertible, I do have a contractual obligation. And hence it will be financial liability. Even though it is convertible into fixed number of equity shares, but if it is optionally convertible, it will be called as financial liability. Right? Now, if it is compulsorily convertible, it will be called as equity. If it is compulsorily convertible, it will be called as equity. Means compulsorily convertible into fixed number of equity shares, it will be called as equity. If the question is silent, we'll assume it is optionally convertible and it will be financial liability. Now, if I have to give the crux of this chart, if I have to give the whole crux of this chart, it will be something like this. See here, all of you, come on. The whole crux of this chart will be conversion rights will be equity. Okay. If principal is convertible into equity of fixed number and compulsorily convertible, okay, and it is compulsorily convertible, then it will be called as equity. And if the interest or dividend are no contractual obligation, then it will be equity. Okay, rest all will be FL. Is this clear, everyone? Please confirm if it is clear, everyone. This is the overall crux of this chart. Though the chart itself was the crux, but now I have made the crux of the crux also. A most simplified one, the most simplified, I think. I cannot make things more simple than this, I think so. Tell me, guys, is it clear, everyone? Is it clear, everyone, so far? What is DOCO? It's no contractual obligation. Aditya, okay? If not compulsory convertible, then it is, if not compulsory convertible, it's equity. Where, Siddhant? Tell me where? Where? Tell me. Where did I tell that if not compulsory convertible? Please see it properly. See here what I have told here. If it is optionally, it is FL. If it is compulsorily, then it is equity. And if the question is silent, it is FL. That's what I have showed here. That's what I have told, right? If it is optionally convertible, it is FL. Compulsorily means equity. Compulsory into fixed number is equity. Compulsory into fixed number. See here, compulsory into fixed number is equity. Now understand guys, treatment of transaction costs. Treatment of transaction costs in compound financial instruments. In compound financial instruments. Okay, in compound financial instruments. Now, standard says that allocate the transaction cost which you have incurred into FL and to equity in the ratio of their carrying amount after you have done the split accounting. After you have done the split accounting. Okay. So let's take up a question on this one. Now. Okay, let's understand. On 1st October 2005, Hill Company issued a convertible bond at par of $20 million and incurred $1 million as issue costs. So now, see what is happening here. Okay, the par value is $20 million. Okay, and I purchased the Hill Company issued the bond also at par value and incurred $1 million as issue costs. Okay, the bond is redeemable for cash on 30th September 2007. Means after how many days? Tell me. After how many days? After 2 years. After 2 years, right? So bond will be settled after 2 years. Okay. Now, is redeemable for cash after 2 years. Okay. Now, bond holders. Now read this part clearly. Bond holders can instead opt for conversion in the form of fixed number of shares. Now tell me, it is what? Tell me. Let me see, you can answer this. Bond holders can opt for fixed number of shares, and it's opt for, tell me, it's what? Equity or FL? FL. Wonderful answer I use. Okay. Interest on the bond is payable at the rate of 4%. This is a coupon rate in arrears. Interest paid in the year has been presented in the finance cost. Okay. The interest on similar debt. Now let's see this point. The interest rate of similar debt without conversion right is 10%. Now let's understand the meaning of this also. Why is this interest rate cheaper? Understand, why is this interest rate cheaper? Let's suppose the founder of Zomato needs loan. Needs money basically. No, forget loan. Needs money of rupees. Let's suppose 1,000 of a dollar. Let's suppose $100 million money he needs. Okay. Now what he does, if he will go and take a loan, he will get the loan at 10%. Now let's suppose everyone knows that the Zomato has a very good future prospects. Everyone knows that in the market that the Zomato has very good future prospects. So now what he does is he goes to the same bank. The founder of Zomato goes to the same bank and says that, bank, see, I don't have 10% interest rate to give you. Okay, I cannot give you 10% interest rate. But what I can do is, when I will settle this instrument, after 2 years, okay, I will give you my equity shares of my company, and that too fixed. I am promising that I will give you this much number of equity shares. I am promising, and now the bank is thinking, okay, if he gives me this much value of equity shares, the equity shares will be worth around somewhere in the range of, you can say, now I am giving you $100 million as a loan, and now that money will be worth around $400 million after 2 years. So don't you think the bank will be fascinated by this offer? Right? And the bank will reduce the interest rate. So why is the interest rate reducing? The interest rate is reducing due to the equity component. The interest rate is reducing due to the equity component. Are you understanding this part? The interest rate is reducing due to the equity component. Now, what are we doing here? Tell me, what are we doing here? See here. See here, all of you, come on. Identify contractual cash flow that are obligation, means it is in the nature of financial liability, and calculate the present value. So we are excluding the equity component, and we are calculating the present value of only financial liability component. So what was the rate of pure financial liability? 10%. So don't you think so? When I am calculating the present value of pure financial liability, I am calculating the present value of pure financial liability. It will be at 10%, not at 4%. Aditya has a query. It must be higher interest rate as it is giving extra right. Aditya, you are not understanding. See here, Aditya. Try to understand this concept. Okay, this is the founder of Zomato, and this is bank. He can take loan $100 million and pay 10% interest rate. Fine, this is a normal transaction. But he doesn't want to do this transaction. What he does is he takes $100 million loan. He says that I will give you now, I will not pay 10%. I will give you right to convert to equity, conversion rights. I will give you conversion rights. Now I am giving already conversion rights. So don't you think because of this right, this will get reduced to 4%? Aditya, does this clear your query? Does this clear your query, Aditya? Okay, now. Okay, so see, since we are calculating the present value of only financial liability component, and this is the rate for pure financial liability component, so what we'll do, we'll calculate the present value using this rate, not the 4% rate. So let's do. So first identify contractual cash flows for principal, interest and conversion rights. See, principal is optionally convertible, hence it is FL. Okay, so 20 million will be FL. Interest is payable annually in arrears. So can I avoid? No, I cannot avoid. So what is the amount? 20 million multiplied by 4%, right? That is equals to 0.8 million. Right? It's a contractual obligation to pay, right? It's also FL. FL. But now conversion rights will always be equity. Right? So what will I do? I will have to calculate the present value of what? Tell me. I will have to calculate the present value of what and what? I will calculate the present value of these two. I hope it is clear to all of you. So far, is it clear to all of you? Now, let's do that. So here 1, 2 contractual cash flows 20 million multiplied by 4% is 0.8 and 20 million multiplied by 4% plus 20 million is 20.8 million, right? Present value factor at the rate of 10% is this much, and present value is this much is the present value. Now what was the issue proceeds? Tell me, what is the value of issue? 20 million. Guys, understand, when I say issue proceeds, ideally I am saying 19 million. When I say issue proceeds, I got only 19 million. But standard says that if you will take 19 million here, what will happen? Tell me, what will be the value of equity? It will become 1.08. So don't you think the whole of this transaction cost of 1 million gets allocated to equity? Right? So standard says that rather than taking 19 million here, don't take 90 million here, rather take full amount here, and calculate the value of equity first. Okay. Now allocate this equity, allocate the transaction cost of 1 million, not 2 million, of 1 million to FL and equity in the ratio of their carrying amounts. So what is the carrying amount? See here, 17.92 and 2.08. 17.92 is the carrying amount and 2.08 is the carrying amount, right? Total comes to 20. 17.92 plus 2.08 comes to 20, right? So 1 multiplied by 17.92 divided by 17.92 plus 2.08, that gives you 0.90, and 1 multiplied by 2.08 divided by 17.92 plus 2.08 comes to 0.10, is the allocation of equity. It is the allocation of transaction cost to equity. Is it clear, everyone, so far? Is it clear, everyone, so far? Now, so what is the revised value of equity? Tell me, what is the revised value of equity? 2.08 minus 0.1 is 1.98, and FL becomes 17.92 minus 0.90 is 17.02. So this is how I will find. Now these values are on which dates? These values are on which dates? On 1st October, on date of issue, of instrument, that is 1st October X5. I hope it is clear to all of you. Please confirm if it is clear or not so far. Please confirm if it is clear to all of you so far. Okay, fair enough. Now understand, guys. We will pay interest at the rate of 4%. Okay, market rate of pure FL is 10%. But now we incurred a transaction cost of 1 million. Attributed to FL is 0.90. Meaning thereby, I will receive 17.02 net in hand for financial liability. I will receive 17.02 net. I receive this much. I will receive this much for financial liability, and I have to pay this much. Means this is my inflow, and this is my outflow. Can you please calculate the rate between them, IRR between them, internal rate of return between them? So it comes to, in the exam they will calculate and give the EIR. They will calculate and give you the EIR. Okay, so this comes to 12.92%. Okay, this comes to 12.92%. Okay, I have calculated and given. So now standard says that you have to do the accounting of financial liability at EIR, and equity will remain constant. How? See here, equity will remain 1.98. Financial liability will change. See how? It was 17.02 here. On the date of issue, it was 17.02. On the date of issue, it was 17.02. Okay. Now I will charge finance cost at EIR, right, which is 12.92%. So what does it come? It comes to 2.20, right? Now what is the value here? Opening plus if finance cost minus the payment, this gives you to 18.42. Same thing, this is opening plus the interest cost or the finance cost minus the payment, this gives you the closing. Now this closing of 20 can be settled in cash, can be settled in equity shares, right? If it is settled in cash, I will pass what? Financial liability account debit to bank. If it is settled in equity shares, what will I do? Again apply the same concept. Of share based payment. I will transfer this 1.98 to here, and from here I will issue equity shares. Or you can say the other way around. If equity share has to be issued, I will transfer the whole this one to here 20. So it will become 20 here plus 1.98. It will become 21.98. From which I will issue share capital. Then at face value, and the difference is transferred to securities premium, the balancing figure. I hope it is clear, everyone. I hope it is clear, everyone. Please tell me, guys, is it clear? So I have taken up a transaction and I have explained the whole flow of it. So I hope this makes the concept much clear now. I hope this makes the concept much clear now. EIR will be given in the question. Yes, Ayush, it will be given in the question. And I believe, Ayush, in the live class we have discussed that how we have to calculate the EIR, right? Though it from an exam perspective, yes, it will be given. But from a practical life perspective, we have already discussed in our live classes that how it will be calculated, okay? Now, sorry. Financial liability measurement is at amortized cost method. Now comes the question, what is amortized cost method? So, discussed above. That is opening financial liability plus finance costs at effective interest rate minus payments is equals to closing financial liability. Is it clear, everyone? Is it clear, everyone? Okay, so this is how your financial liability is to be measured. Okay, now financial assets. Okay, what are financial assets? Tell me, what are financial assets? Financial assets are contractual right to receive cash or contractual right to exchange financial assets or financial liabilities in potentially favorable conditions. Tell me yes or no, right? Like investment in equity shares, like first thing should come cash, trade receivables, investment in debentures, investment in bonds, investment in equity shares, investment, be it anything. Whenever you have a contractual right to receive cash or any other financial asset, that is called as financial asset. It can be anything, cash, investments, trade receivables, it can be anything. Security deposits, loans given, right? It can be anything. Wherever you have the right to receive cash, that is a financial asset. Now let's suppose you have given advance to your supplier. Is that a financial asset? You have given advance to your supplier. Is that a financial asset? Tell me, guys, all of you, come on. We have given an advance to our supplier. Is that a financial asset? If yes, then why? If no, then why? All of you, please answer. Nutan, no. Why? Why is important? In SBR paper, only thing which is important is why. You need to answer why. Siddhant is saying yes. Advance given to supplier. Why will you give an advance to your supplier? Siddhant, tell me, why will you give advance to your supplier? Right? We will receive service or we might receive goods. So we will receive goods or services, right? We will receive goods or services. So when we receive goods or services, is it the cash we are receiving? No, it's not cash. So it is not a financial asset. Very good, Ayush. Okay, now understand. Financial assets. Okay, so I discussed the meaning and the meaning. Okay, now see, financial assets can be measured. Just a minute. Financial assets can be measured at either amortized cost method, like the financial liability, or fair value. Fair valuation can also be done through P&L or through OCI. See, unlike liabilities, might be SBP. Okay, unlike liabilities where it is measured only and only at fair or at amortized cost method, financial assets can be measured at more than that. Okay, it can be measured at amortized cost, it can be measured at fair value, and the fair valuation can happen through P&L or it can happen through OCI. Now we need to understand in which cases, how will we understand that which classification shall we apply? Is it ad hoc? Is it ad hoc? No, it cannot be ad hoc. It cannot be ad hoc, right? It cannot be ad hoc, right? So understand what is the basis of classification. What is the basis of classification? Understand. So standard suggests us two tests. One is business model test and another is contractual cash flow test. Okay, business model test is from the entity perspective. Understand, guys? It is from an entity perspective, and contractual cash flow test is from the asset perspective. Now understand. What is the intention for the entity? What is the intention of the entity? If the intention of the entity is to hold the instrument, see the instrument intention of the entity can be, I will hold the instrument, come what come may, I will hold the instrument. Another intention can be, I will hold this instrument, but if I get some better returns, I will sell it off. Third intention can be, I have purchased this asset for selling it off. I will purchase this asset for selling it off. Okay, for selling it off. Now, so these three can be the possible intentions. Aditya, understand? You are asking me how to measure at amortized cost method. This method is called as amortized cost method. This method of financial liability is called as amortized cost method. Wherein we calculate EIR, wherein we calculate effective interest rate, wherein we calculate the finance cost at the rate of effective interest rate, okay, on the carrying amount, opening plus finance cost minus payment is equals to closing. This is what is called as amortized cost method. Okay. FL can be measured at FBTPL. We'll discuss that point, not discussing it now. Okay, we'll discuss that point, but not now. Okay, hold on for that. Hold on. Now understand. So yes, I was discussing business model test of financial assets. I was discussing business model test of financial assets. So the intention can be three intentions. One, I will hold it till maturity. But if I get better returns or higher returns, I will sell it off. Or I have purchased this asset for selling it off. That is held for trading. Okay. Now, contractual cash flow test. We need to analyze that from the instrument, I have to receive only principal and interest, and that too on specified dates, and no other rights. Contractual cash flow test means only principal and interest, and that too pre-specified dates, pre-specified date, okay, and no other returns. Okay. Now standard says that if business model test A, that is hold till maturity, plus contractual cash flow test gets satisfied, we have to apply amortized cost method. Meaning thereby I have given a loan to someone, I will get principal, I will get the repayment of principal, and I will get interest on every specified dates. Okay, I will have to do the accounting of amortized cost method, like the way we used to do for FL. Now, but standard says if business model test B satisfied, means I will hold till maturity, but I can sell if better returns are available. Plus, from the instrument I will get only principal and interest. On specified dates and no other rights. I can measure it at FBT OCI. All others, whether it is held for trading, whether the contractual cash flow test doesn't get satisfied, whatever is the case, all others are to be measured at FBT PL. Now, there are certain exceptions to this rule. Understand, before we understand the exceptions, tell me the default rules. Investment in equity shares. Tell me, can I say that it can be hold till maturity? Is there any maturity for investment in equity shares? Tell me. Let's suppose I purchased the the shares of Reliance. You can say any maturity? No maturity. Will I get principal and interest on specified dates from them? No. So both of these conditions doesn't get satisfied, right? So it will fall under all others. That is FBT P&L. So the default classification of investment in equity shares is FBT P&L, but the standard gives us an irrevocable option. The standard gives us an irrevocable option to measure it at FBT OCI, on initial recognition, not after that. On the date when you purchase, you can measure it, you can classify it as FBT OCI, but not subsequently. But that too also if it is for long term and strategic reasons. Are you getting this point? All of you, please tell me. Are you getting this point? Fair enough. Now let me ask you one question. I have answered many questions, right? Now you guys answer one question of mine. Investment in convertible bonds. Tell me how it should be measured. How it should be measured? Investment in convertible bonds, tell me how it should be measured. Now, till now I answered all your queries, right? Now it's time for you guys. Tell me. Time for some fun. No, it doesn't depend. Okay, it depends on what? Even if I say Nutan that ignoring all the factors, there is one factor in this one which can change everything. You don't need to assess anything. There is something in this question. Investment in convertible bond. Tell me. Okay, I'll give you. If you think it depends, I will say you it is hold till maturity, and you get principal and interest. From bond means you get principal and interest. Tell me then, Nutan. Why FBTPL Aditya? Why FBTPL Siddhant? Has other right. Basically, it has conversion rights. It has conversion rights as well, right? It has conversion rights as well. See here, see where it is. And no other rights, guys. No other rights. CCFT fails. CCFT fails. Conversion right exists. Is it clear, everyone? So hence the classification will be FVTPL. I hope it is clear to all of you. Now understand the measurement of the three assets. The three types of classification, measurement of three types of classification. If FA is under amortized cost method, if FA is under FBT OCI, if FA is under FBT P&L. Understand guys. When FA is at amortized cost method, okay, you will capitalize the purchase price plus the transaction cost. Okay, whatever transaction cost which you pay to purchase that FA. Let's suppose I have invested in bonds. Okay. And of $2 million, okay, to purchase that bond I have to pay the brokerage of, let's suppose, 0.1 million. So 2.1 million will be the value of my bonds that I will capitalize. Okay, so purchase price plus transaction cost. Similar way for FBT OCI as well, right? But for FBT P&L, the transaction cost is transferred to P&L. Whenever we record amortized cost method, we record finance income at effective interest rate method. The same way we used to do it for financial liability. Guys, I hope you are able to recall. It. Okay. See, what is the purpose of this revision session is, whenever I start discussing, you try to recall everything. Whatever you have studied. Okay. And that becomes fresh for your exams. So whenever after this class, when you start reading these notes, nothing is new for you guys. Nothing should be new for you guys, okay? Now in FBT OCI I will also record finance income at effective interest rate, but there is no finance income that is recorded in effective interest rate at effective interest rate for FBT P&L, but rather whatever amount I receive, I record as FBT P&L. Now tell me a question, again a question. I have invested in convertible instruments, convertible bonds. I have invested in convertible bonds. Guys, please listen to my question carefully, all of you. Please listen to my question carefully, all of you. I have invested in convertible bonds. Okay, I have invested in convertible bonds. See this question. I have invested in these convertible bonds. Okay. Will I classify it into equity? What is the equity component and what is the financial asset component? Will I classify what is the equity component and what is financial asset component? I have invested. Will I classify what is equity and what is financial asset like the way the issuer does it, equity and financial liability? So will I also do it? What is equity and what is financial liability? What is financial asset? No. Why? Come to the top. For the person who has invested, it's always only financial asset. For the issuer, it can be financial liability or equity or both. That's the reason why they need to classify. Now, so can I say whatever amount I receive, and if it is, and investment in convertible instruments is measured at what? Tell me. This is the question, right? Investment in convertible instruments is measured at what? Is measured at what? FBT P&L, right? Now, so what will I do? Will I record interest, effective interest rate? Will I record effective interest rate? Will I record effective interest rate for if I have investment? No. So what will I do? I am receiving this 4% interest rate, right? So this amount which I receive will be my finance income. Okay, this amount which I receive will be my finance income. Understand, Aditya? I have invested in convertible instruments. Okay, I have invested in convertible loan notes or convertible bonds. First thing, I will not segregate my investment. Into financial assets and equity, right? Because for the person who has invested, there is no concept of equity. There is only concept of financial asset. First point. Second point. Since it is convertible, since I have invested in convertible instruments, it is measured at FBT P&L. So whatever interest I receive at the rate of 4% will be my finance income, and I am not required to calculate any EIR or anything of that sort. I hope it is clear now, all of you. I hope I am clear now, all of you. And here, come here. Now, in this case, no, and the fair value changes. Here I will ignore the fair value changes. Here I will transfer to OCI, and here I will transfer to P and L. Okay, is it clear so far? Please confirm if it is clear, everyone, so far till here. Please confirm if everything is clear so far till here. Now comes to special cases. Test, yes, in which case? Okay. Now, loan to employees at less than market rate. I was discussing this point in share-based payments, right? And I told that I will discuss this in detail in financial instruments. Do you remember this? Loan to employees. Tell me, guys. Do you remember this concept of loan to employees? I was discussing this point in share-based payments, right? So what happens? See, guys, understand. If loan to employees has been made at a general market rate, treat it as like a normal financial asset. No change. Okay, I have already discussed the accounting. I am written here. What I have written here? Special case, right? यहाँ देखो मैंने क्या लिखा है, स्पेशल केस. स्पेशल केस मतलब समथिंग डिफरेंट, something different to what we have already discussed. Now understand. If I am giving the loan to employees at a general market rates, already discussed, not a special case. But if I am giving loan to my employee at, let's suppose market rate is 10%, I have given him at 6%. I have given some benefit to my employee. Why? Because he was my employee, because he is my employee. Or there are also cases where I give loan to my employees without interest. Interest free loans are also given, right? So interest rate in the market is 10% and interest rate that I collect from employee is 0. So why I am giving this benefit? Because he is my employee. So what the standard says for this is, the standard says whatever amount you have given to him, okay, calculate the present value of the contractual cash flows, contractual right to receive cash flows, calculate the present value of it, okay, whatever amount comes, and the present value calculate using market rate, and record that as loan, and let's suppose you have given X amount. What is the difference? You record it as an employee benefit expense. I will take up an example. Let's suppose I have given $1 million to my employee at the rate of 6%. Market rate is 10%. Okay. Now he will repay after 2 years. 100 million. 1 million. Sorry, not 100 million. 1 million. $1 million. So its standard says that calculate the present value at the rate of 10%. What is the amount comes up? Tell me. What is the amount comes up? 0.826. So standard says that record 0.826 as a loan to employee. Okay, but you have paid 100,000. Sorry, I write it like this. 826,000. Okay, but you have paid $1 million. Okay, so standard says the difference is the difference. Why is the difference? Because of 826,000 minus 100,000 is 174,000 is your employee benefit expense. This difference is 174 is your employee benefit expense. Is it clear, everyone? Okay, the question is whole difference is attributable to the first year itself. Good question. Let me explain this point. If the question says, or if the contract says there is a service condition, means I am giving a loan to my employee, but the employee has to work for 2 years. So the employee has to work for 2 years, service condition. So this 174 will be recorded over 2 years. If there is no service condition, I will recognize it as an expense now itself. Expense immediately. Okay, over 2 years, expense over 2 years. Does this answer your query, Nutan? In which ratio? Equal ratios. No ratios. Equally over 2 years in SLM basis. No ratios. Okay, equally. Okay, does this answer your query, Nutan? Now, same thing for security deposit at interest free. Like let's suppose guys or girls who are staying in PGs, right? Or they have rented apartments, staying in rented apartments. So what will I do? In that case, what will I do? Present value of only principal. No Neha, not only principal. Okay, I'll write here 0%. Okay. because it will become 0, it will become difficult. Okay, it will become difficult. Not only principal, I have to calculate the present value of all the contractual cash flows. Okay, all the contractual cash flows. Okay, Neha, very good, pointed out. Okay, very good, pointed out. All the contractual cash flows, Neha. Okay, all the, whether it is interest or principal, whatever I will receive from him, I will calculate the present value of it. Okay. Now, if it is security deposit at interest free, security deposit which is interest free, I will do again the same thing, right? So what I will do is I will calculate the present value of it and I will record the security deposit using the present value, right? And whatever is the difference is the rent expense. Now again, this rent expense can be recorded in the same year if there is a lock-in, if there is no lock-in, or can be recorded over years. Over years. Due after the commencement of IFRS 16, after the commencement of IFRS 16, what the standard says that this rent expense, rather than writing a rent expense, you write here ROU asset. You write here ROU asset. Okay, this is the change. Okay, but even if you write in the exam rent expense, that is also acceptable. Okay, that is also acceptable in the exam. Okay, is it fine? Is it fine, everyone? Is it clear so far? Please confirm. Now, coming to de-recognition of FA. When will we de-recognize financial assets? Please understand. When do we recognize a financial asset? Whenever we have the right to receive cash flow. Whenever we have the right to receive the cash flow, we recognize the financial assets. We recognize the financial assets. But when this right to receive the cash flow gets expired, we de-recognize the financial asset. We de-recognize the financial assets. Okay, or this is one, or I write here or when the when the contractual right to cash flow is transferred. See, here it's expired, here it gets transferred, right? It gets transferred with substantial risk or rewards, or along with control. Either risk or rewards or control. Let me explain it to you. Let's suppose I have sold my trade receivables to a bank. I have sold my trade receivables to the bank on a non-recourse basis. Meaning thereby, if the trade receivable defaults in payment, the risk is of the bank. If the trade receivable pays early, the reward is of the bank. Okay, I am no more interested in the asset. I will say I have transferred the asset to the bank with substantial risk and reward. Okay, so this is, so either your right to receive cash flow gets expired because you have already received the money, or you have transferred your right, with substantial risk or reward, or with control. Either of them. Okay, in these cases you de-recognize the asset. You de-recognize financial asset. I hope it is clear to everyone. Now, coming to asset liability mismatch. Though I don't take up this topic ideally, but let me explain this point. Okay. Guys, understand? Let's suppose I took a loan from the bank. And I invested that money in equity shares. I took a loan from the bank and I invested the same money in equity shares. I don't know whether you are understanding it or not. Let me explain it to you. Understand? This is me, okay. I took a loan from a bank. Loan. Tell me, loan is what? Financial liability. And I invested this money in equity shares of, I will not say Reliance because someone will say again, that sir, you are favoring Reliance, you are in lot in what he said, I don't know, I don't remember the term also, he said something in the previous class, so I will not take the name itself of Reliance now. Okay, now understand, I took a loan and I took equity shares of investment. I invested that money in the equity shares of Infosys. Tell me guys, this investment in equity shares is my asset, is my financial asset, is my financial asset, is my financial asset. Tell me, this financial asset will be measured at what? Will be measured at what? Will be measured at what? Come on guys, tell me. FVTPL. This loan will be measured at what? Amortized cost method. The loan is utilized for investment. The loan is utilized for this investment, right? So don't you think the risk and the rewards pertaining to the loan and the asset is the same, pertaining to the liability and the asset is the same? The risk and the rewards pertaining to the asset and the liability is the same. Tell me guys. So your standard says that this is an accounting mismatch. This is an accounting mismatch. The asset and the liability are being measured differently for the same purpose, right? So in this case, what you have to do is you have to measure this also at FVTPL. Okay, this is called as accounting. See, understand, if FL is always measured at ACM, but to reduce inconsistency in accounting, I have to measure, I can measure FL at FVTP and L or FVT OCI. But you will realize the benefit from the share basis market rate and the loan is committed to pay out. I totally agree with you. Ayush, totally agree with you. But understand. This loan is utilized. This loan I am utilizing to pay this. This loan I am utilizing to invest in this equity shares. Okay, to invest in this equity shares. So the asset and liability are used for the same purposes now. Right? They are related. They are closely related now. So standard says that you cannot. This is accounting mismatch. This is an accounting mismatch. Okay. So for in these type of cases, both the asset and the liability should be measured at FVT P&L. Okay. Or if it was measured at FVT OCI, then you have to measure this also at FVT OCI. How I'll tell you. Income I am recording in the P&L. Income I am recording in the P&L, but expense I am recording in OCI. Does this look good? All right. So if you are recording your investment income in P&L, record your investment expense also in P&L. Okay. So that's what it says. That's all. Nothing else. Now coming to the executory contracts. Understand, guys. Do netting off in the P&L as well in the P&L while recognizing? No netting off. Separately we recognize. No netting off. Separately we'll do. Okay. Executory contracts. Understand, guys. So guys, whenever we enter into any contract to buy any non-financial item, not only buy, I'll write here sell also, to buy or sell any non-financial item, and this is for own consumption. Means I enter into contract with Ayush to purchase 100 kgs of rice, or I enter into a contract with Ayush to purchase 1000 leaf of paper. I need papers, I need paper, I need papers, right? For my book, I need paper. So this is for my own consumption, right? This is for my own consumption. This is out of scope of IFRS 9. This is out of scope of IFRS 9. But understand, Ayush, let's suppose I intend to contract with you that I can purchase own consumption is for buy, or it can be for sale also, right? Basically, let's suppose the person to whom I am selling, it's for his own consumption, right? Now understand guys, all of you, please come on. Okay, it can be buy, it can be sell, it can be anything. Understand the meaning of contract. You can say executory contracts. Let's suppose if I have entered into contract to buy any fixed quantity of anything at a fixed rate. I fix the rate also today, okay, but it is for my own consumption. Then it's an executory contract. But let's suppose if I enter into a contract where I can do the net settlement. What is the meaning of net settlement? Means I have a contract to buy at rupees 100 per kg, or rupees 10 per leaf of paper, but the rate becomes 20, or rate becomes 12, but the rate becomes 12. So rather than buying, I'll just take 2 rupees from him per paper. I'll just take 2 rupees from him, right? I'll not take the delivery, I'll just take 2 rupees from him per paper. Okay, so let's suppose I have intended to contract with Aditya that I will purchase 100 leaf of paper at the rate of rupees 10 after 3 months. After 3 months, I can do 2 things. I can do physical settlement, or I can do net settlement. I can do net settlement. Now let's suppose if I have to do net settlement, meaning what will I do? The rate then becomes, let's suppose, 12. So what will I do? 100 piece of paper at 10 rupees was a contract, right? The price is 12 now. So 12 minus 10 is 2 rupees per paper is my profit. And what was the number of paper? 100. So 2 multiplied by 100 is 200. I'll take 200 from him. That's all. I'll take 200 from him. That's all. Standard says that these type of contracts are within the scope and are called as derivative contracts. They derive their value from the underlying. They don't require any initial investments, and they will settle in the future dates. Is it clear, everyone? In derivatives, no delivery, right? Derivatives, no delivery. If you want to take delivery, it will come here. If you want to do net settlement, it will come here. Okay, now coming to the next point, impairment of financial assets. Understand, guys. First, understand which financial assets. Understand, guys, there are a lot of financial assets. Understand, let me explain that. Understand, financial assets can be measured at amortized cost method, can be measured at fair value through P&L, can be measured at FVTOCI, and there is one more thing, that is investment in equity shares, which can be measured at FVTOCI. But this is irrevocable. Irrevocable means it cannot be classified to P&L. Understand? Amortized cost, it is at cost. So it requires to be impaired. Okay. Now FVT P&L, it is already at fair value. Why do you want to impair it? Tell me. It is already at fair value. Will we impair it? Tell me. Will we impair it? No. It is at fair value through OCI. Will we impair it? It's at fair value. Will we impair it? Will not impair the asset, but what we'll do? See, what is the impact of impairment loss? We recognize, we book an expense in the P&L, right? We book an expense in the P&L. But here the expense or gain is booked in OCI. So what will I do? Rather, I will just recycle OCI to P&L. That's all I'll do. But now understand, if investment in equity shares is at FBT OCI, can I recycle you? Tell me. Will I impair? No. But can I recycle? No, I cannot recycle as well. I cannot recycle as well, right? So I cannot. So what are the two type of assets which I cannot do impairment? So I cannot do impairment on these two assets. See here, no impairment on these assets and no impairment on these assets. Rest all I will impair. Tell me guys. So I see that's what I have done. FA at amortized cost method, FA at amortized cost method, and FBT OCI except investment in equity shares. Is it clear, everyone? Is it clear, everyone? Fair enough. Now, how to do that? See, when we do impairment, or it is called as ECL, expected credit loss. It is called as expected credit loss. Okay, it is called as ECL. So how do we find ECL? We need to calculate the present value of the future cash flows that will not be received. Okay, present value of the future cash flows that will not be received, present value of the future cash flow that will not be received. And for 12-month ECL, I have to multiply this with probability of defaults in the next 12 months. Okay, and if it is lifetime ECL, I have to multiply it with 100%. Lifetime ECL means multiply with 100%. Now comes the question, how to determine whether it is 12-month ECL or lifetime ECL? If the assets are credit impaired either at the time of acquisition or subsequently, if it becomes a credit impaired, then I can say that we will have to go for 12-month lifetime ECL. We will have to go for lifetime ECL. I hope it is clear to everyone. Both are that itself, Nutan. Both are provision. Whether this or this, both are provision itself. Both of them are provision. But yes, the case is very severe in the case of lifetime ECL, and the case is not as severe here. Okay. The case is see, understand what I was trying to say here is, whenever we have to test the asset for impairment, I will test financial assets for impairment. Financial assets at FBT P&L will not be impaired because it is already at fair value, and the impact has gone to P&L. The assets at fair value through OCI will not be impaired. Why? Because it is already at fair value, but the impact has not gone to P&L. So what will I do? I will recycle the OCI to P&L. But the investment in equity shares which are measured at FBT OCI will not be impaired. Why? Because they are already at fair value. But can I transfer the can I recycle the OCI to P&L? No. Why? Because this is not recyclable. First part. Second part, ECL, expected credit loss, can be of two types. One is 12-month ECL, another is lifetime ECL. When I will do a 12-month and when I will do lifetime? Into a lifetime, I will do whenever the asset is credit impaired either at the time of purchase or subsequently it becomes credit impaired, then I will say it is to a lifetime ECL. In all other cases, I can say it is a 12-month ECL. 12-month ECL means I don't doubt that I will receive the payment, but yes, I am just being you can say conservative. Okay, I am just being conservative. Okay, the asset is not credit impaired. Okay, I just have you can say a very little doubt. Very little doubt. Okay, like remember that one. In NBFC we record a provision on standard assets also, right? We record provision on standard assets also, right? So that's what is here. Aditya, my query please. What is your query, Aditya? Last query. Aditya, I have come to a next point, right? Let me please complete this point and then again I'll go. Do you want me to leave this point in middle and go to your point? Please cooperate, guys. Okay, understand. So first I will have to classify whether it's 12-month or lifetime ECL, right? So I have to see whether it is asset is credit impaired or not. If it is credit impaired, we will create lifetime ECL. Otherwise, we will create 12-month ECL. Okay. Now, in 12-month ECL, we calculate the present value of all the future cash flows that I will not receive, multiply with the probability of default within 12 months. Multiply with the probability of defaults. But in lifetime, I multiply with 100%. Whatever is the amount that I am supposed to not receive, let's multiply the whole amount. Let's create the provision for the whole amount. Now, what is journal entry? When the asset is under amortized cost method, I will record P&L account debit to provision for loss allowance. If the asset is under FBT OCI, will I record a provision? No, but I will just recycle from OCI to P&L. I will recycle from OCI to P&L. The amount of impairment loss. Now understand one more thing in this itself. If the asset is we have created 12-month ECL. If we have created 12-month ECL, okay, presentation in FS. In financial asset, in financial statements. So how will I present this in the financial statements? Understand, guys? So what will I do here is, I will show what is my financial asset. I will record minus provision for loss allowance, and this is the net FA I will disclose in. My financial assets, whether 12-month ECL or this one. Okay, now whatever it is, or lifetime ECL, whatever. But now let's suppose if I have to calculate finance income. On financial assets under amortized cost method, then how will I do that? Let's discuss this also. Finance income. If it is 12-month ECL, I will calculate finance income on gross assets. On gross financial asset. But if it is lifetime ECL, I will calculate finance income on net assets, but prospectively. Let me explain this point. Let's suppose at this year end, on 31st March 2022, I created a lifetime ECL. Okay, on a financial asset. So when I am calculating the finance income for 31st March 2022, I will record on gross or net. I will do on gross. But after that, that is from 1st April 2022. I will start recording on net assets. Prospectively, I will record on net assets. Is that clear? Everyone? Everyone, please confirm. Is that clear, everyone? Fair enough. Now, going back to the Aditya's query, delivery but not own consumption. Then what? Okay. See, I have written here one more point. See here. You have taken the delivery but you are not consuming. You will sell it. You will quickly purchase and sell it off. Quickly purchase and sell. Then also it's covered here. Aditya, I hope this answers your query, Aditya. Ayush also has a query. Fluctuation in the value of trade payables on the forward contract safeguard against foreign currency fluctuation. How will it be recorded? Ayush, it will be recorded as per IAS 21. Okay. When there is a fluctuation in the trade payables, when there is a fluctuation in the foreign trade payables, so it will be recorded as per IAS 21 as a forex gain or loss. And if you have taken a forward contract on that, that is a derivative contract. So that you will account as per derivative contract. Okay, Ayush. Now, our next point is derivative. What is the meaning of derivative? Three features, and here it is and. Okay, understand? Three features. It requires low or nil initial investment. Value is based on the underlying. value is based on underlying, and it is settled in a future date. Okay, how it is measured? At FBT P&L. Now let's suppose I have entered into a contract. I have entered into a contract with IOs that see, I have foreign trade payables. I have a foreign trade payable. Okay, so what is my risk? What is my risk? The currency rate will increase, right? And I have to pay higher amount. So I will enter into contract. I will enter into contract, right? I will enter into contract to buy I will enter into contract to buy foreign currency in the future, right? Tell me yes or no. To buy foreign currency in the future, right? I will buy foreign currency in the future, right? At a fixed rate, the rate I am fixing now, right? So now I might enter into contract at some rate here, right? That rates might change. I will have to compare that rate with again and the forward rates, and that will give you a gain, or that might give you a loss. That might give you a gain, that might give you a loss. These gain or loss is happening on derivative contracts. IOS. So if you have a foreign trade payables, foreign rate is changing, that is covered in IS 21. But if you have a foreign trade payables and you have taken a forward contract on that, so that forward contract will be measured as per IFRS 9 on derivative contracts. Is it clear, everyone? Ayush, does this answer your query? Ayush, and in the class, in our live classes, I believe we have taken a sufficiently good example also on this one. Now come to the hedge accounting. Hedge accounting. Now understand. Hedge accounting, understand, to do hedge accounting, we have to satisfy all the hedge conditions. To do hedge accounting, we have to satisfy all the hedge conditions. So what are the hedge conditions? Primarily three, that it should be an eligible hedge item and eligible hedge instrument. What are the eligible hedge items? Asset or a recognized asset or a liability, a firm commitment, or a highly probable forecast transaction, right? Recognized asset, liability, a firm commitment, or a highly probable forecast transaction. I believe recognized asset, liability is clear to all of you. Firm commitment means what? I am entered into a binding contract. Right? For any binding commitment, right? Binding contract, that is called as firm commitment. Okay. There is no binding contract. But there is a high probability that I will enter into this contract. It's called this one, highly probable forecast transaction. Okay. Now, hedge documentation should be there, and the hedge should be effective. Effective hedge means it can be perfect relationship. It can be imperfect also. But even if it is imperfect, it should be within the boundaries. If it is within the boundaries, I can say it is effective. Is it clear, everyone? The hedge conditions. Now, types of hedge. There can be two types of hedge. The two types of hedge are fair value hedge and cash flow hedge. Yes, if ineffective hedge we are not considering here. Okay. What is the why we are not covering? Because see, what is the purpose of hedge? If there is a loss in the hedged item, there will be a gain in the hedge instrument. Right? Now, what is the meaning of effective hedge? There is a close economic relationship. Between the hedged item and the hedge instrument. And it mitigates the risk. Basically, if I am getting a loss in the hedged item, I will get a gain in the hedge instrument, so that the loss offsets with the gain. And our purpose to hedge is met. Now understand, what is the meaning of fair value hedge? See, generally we take fair value hedge in the cases where we have a risk of decrease in the fair value, right? We have a risk of decrease in the fair value, like for example, non-current assets, like for example, you can say inventories, right? So what we do here, see, in fair value hedge, what we do, we revalue the hedge instrument, and transfer it to P&L, okay, and whatever is the gain or loss in the hedge instrument, we adjust it to the hedged item. We adjust it to the hedge item, right? We adjust the same with the hedged item. But in cash flow hedge, what will you do? We will revalue the hedge instrument on every reporting date and we transfer it to OCI. We transfer it to OCI. We transfer it to OCI. And when this instrument is settled, I will recycle it to P&L. I will recycle it to P&L. Is it clear, everyone? I will recycle it to P&L. Is it clear, everyone? So basically, in the case of fair value hedge, the fair value gain is adjusted with the hedged item. In the case of fair value hedge, we adjust the fair value gain with the hedged item. Okay, but in the case of hedge instrument, cash flow hedge. In the case of cash flow hedge, we take it to OCI, and whenever it is settled, we transfer it to we recycle it to P&L. Okay, we recycle it to P&L. So that's all from a financial instruments perspective, guys. Now we will start our next topic, that is APM. Okay, so let's take a quick break of 5 minutes before that, and then we'll start APM. No, Vishaka, in the cash flow hedge, we will transfer we will transfer the gain or loss in the hedge instrument to OCI, okay, to OCI, and I will then I will transfer it to P&L on recyclement. Okay, whenever it is settled, I will transfer it to P&L. Let's assume, guys, let's assume okay. So Vishakha said that in cash flow hedge will not adjust with the okay. No, in fair value hedge we adjust with the hedge item, but in cash flow hedge will not. In cash flow hedge, whatever is the gain or loss in the hedge instrument, I will transfer it to OCI. When that cash flow hedge instrument, when the hedge item gets settled, I will transfer the whole gain or loss that I have transferred to OCI, and I will recycle it to P&L. Okay, because the gain or loss on the hedged item will go to P&L at the time of settlement. Understand? When we do cash flow hedge, the gain or loss on the hedge item goes to P&L at the time of settlement. So till the time it is not settled, the gain or loss on the hedge instrument is just accumulated in OCI. As and when you record your gain or loss on the hedge item in P&L, I will recycle from OCI and transfer to P&L, so that this gain or loss gets knocked off. Okay, though we will not knock it off, but yes, it will not have any impact in the P&L. Okay. Now come to APM. Additional performance measures. Guys, understand? Though there is nothing to study for APM, there is only to practice. There is only to practice in APM. Okay. But yes, there are few points which I want to discuss with you guys. For regarding APM. Let's discuss few advantages and disadvantages, right? But guys, there are 4 articles given in your ACCA website. And I will recommend you guys to please read the articles. The more you read, the more better you will write in the exam. So the only key to success here is read. Okay. Yes, cash flow hedge condition has to be satisfied to do hedge accounting. If the hedge conditions are not satisfied, you will not be able to do cash flow hedge or fair value hedge, whatever it is. Okay. Now understand advantages of APM and disadvantages of APM. Advantages: it increases comparability, because see in the IAS or the IFRS which we follow, it doesn't say that please compare, please do the analysis of it. No, it just see it's a legal obligation, and we just follow whatever is given. Okay, okay, and it increases the comparability. Okay, so first is comparability, second is controllable. Understand? It makes the P&L much more comparable. Why? See, in the P&L which we prepare, there are a lot of costs which are not comparable, like tax. When we are doing APM, we remove tax. Like certain non-recurring expenditures. Okay, we remove that. So basically, we compare only what is controllable, which is controllable. Okay, which is controllable and maintainable. Okay. Now here we do in-depth analysis. Okay, of basically, see, in when we do IFRS, we just account as per what is given, but we don't do analysis. In APM, we are doing the analysis. We are checking, okay, this is what was the ratio previous year, this is the ratio in the current year, this ratio has increased, this ratio has decreased. What is the reason of increase or decrease in the ratios? Okay, this is what is the increase or decrease in the ratios, is what you assess. Liquidity versus profitability. Understand, guys? The profit after tax which you calculate in your P&L is your profitability. But can you tell me how much of that profit is realized? How will you assess how much of that profit is realized? So what you do is you calculate EBITDA. What is EBITDA? Earning before interest, tax, depreciation and amortization. See, depreciation and amortization are non-cash expense. Remove it off. Tax and interest are you can say tax is something which is not controllable. Remove it off. Interest is something which is pertaining to the capital structure of a company. Let's remove it off. Now this is now it brings it more closer. This brings it more closer to the cash profit. So it can also be said that APM serves as a measure of, you can say, bridging the liquidity with the profitability. Bridging the liquidity with the profitability. In accounting, when we do, there are a lot of adjustments that we use, right? There are a lot of adjustments that we use, okay? But here the adjustments are, you can say, the estimates or the judgments are very less, okay? See, no, this is not an advantage. Sorry, just a minute. Sorry, okay. Now coming to disadvantages. See, it can be manipulated. Why? Because there is no governing standard. Right? It excludes non-recurring items. See, when in the name of non-recurring items, it sometimes includes items which though are non-recurring, but is very much required. To be adjusted. Okay, so excluding non-recurring items can be a negative point sometimes. Okay, so now again, it has inconsistencies. Let's suppose in the previous year I took some other formula, in the current year I am taking some other formula. Since it is not governed by any standard, no one will question me, right? So again, it has inconsistencies. Lack of transparency. What if I say that my gross profit is increased by 25% during the year, and when calculating gross profit, I have considered the finance income also, which ideally I am not required to do though. Okay, I cannot consider gross income. I cannot consider finance income, right? Any other income. I can consider what is my revenue. I can consider what is my cost. Whatever profit comes is your gross profit. If I have considered the finance income also, then what? So lack of transparency. There is no defined framework. Okay, so these are the advantages and disadvantages. Understand. Examples can be EBITDA, net financial debt. Okay, net financial debt is what? What is net financial debt? Understand. It is your debt. It is your debt. It is the debt in the company minus cash balance in the company. Okay. Now, what is the requirements of APM? How do you ideally disclose an APM? Standard says your article says that whenever you have to do your disclosure of APM, when you are disclosing any APM, first define that APM. What is the formula? Then see, let's suppose I am calculating EBITDA. Reconcile that to FS. In the FS, what is there? Profit after tax. Reconcile the profit after tax to EBITDA. If you are disclosing net financial debt, reconcile your net financial debt to the total debt in the FS. Okay, reconcile. It should be given less importance, or it says less prominence. It should be given less importance and less prominence. What is the meaning of less importance or less prominence? Is you cannot disclose it in the face of P&L or balance sheet. You cannot disclose in the face on the P&L or balance sheet. No, you cannot do that. You have to disclose it with the comparatives. If your gross profit margin is this much in current year, what was this in the previous year? Okay. If you are changing, let's suppose you are changing the formula, state the reasons. If you are in the last year you gave gross profit margin, but in the current year not giving it, write the change. Write why. So these are the certain requirements revolving around APM. Let's take up a question on APM and discuss it off. Okay. Let's discuss a question on APM and discuss it off. Yes, Visakha. Yes. Now, see what the question says. Throughout its other business operations, Kate is reliant on skilled workers to design and manufacture high-tech products. Because of the importance of the Kate's workforce to design the operations, directors wish to disclose the following key performance indicators in the annual integrated report. It says that the average salary of the employee is this much in 20x3 and this much in 20x2. Can you please calculate the rate of change? 1.23 percentage. The rate of change of this one, revenue per employee 116432 minus 102124 is 14 percentage, right? And this one also you do. Okay, leave these ones. Now understand. Tell me the salary, understand guys, all of you please come on, understand. Your salary has increased by 1.23 percentage, but the revenue has increased by 14 percentage. First point, which you have to analyze. First point. Second point, your salary had increased by 1.23 percentage, but the inflation rate in the country is how much? See here, 2 percentage. This is the second point which you have to understand here. Now, using these 2 points, you have to analyze. See, your employee turnover has increased by what percentage? Tell me. Increased by what percentage? 18.7 minus 13.9 divided by 13.9 is 34 percentage. Employee turnover has increased by 34 percentage, and not only this one, it exceeds market rate. See, in the market, the rate is 14.1 percentage. Market rate of 14.1 percentage. This is the third point. Now, fourth point which you have to understand is, okay, sick days has also increased by how much? 4.9 minus 2.1 divided by 2.1 into 100 is by 133 percentage. Understand guys, what is happening? You have to analyze these 4 points here, okay. Your salary has increased by 1.23 and your revenue has increased by 14 percentage. Okay, I just calculate the increase in the percentage. Okay, I just calculate the increase in the percentage. Okay, now increase in the percentage I use. Okay, okay, fine. Okay, if you want me to, I just in growth percentage. Okay, growth percentage. Understand? Now understand that salary has increased by 1.23 and revenue has increased by 14. This will create a dissatisfaction among the employees that your revenue per employee is increasing by 14 percentage, but you are increasing your salary by 1.23 percentage only. This will create a dissatisfaction among the employees, right? Dissatisfaction among the employees. First point. Second, your salary is not even matching the inflation rate. It means their purchasing power parity will fall down. It means their purchasing power parity will fall down, right? If it's not even matching the, you can say, inflation rate in the country. Right? Inflation rate in the country. See guys, again understand, your salary is increasing by 1.23 percentage is average increase, right? Meaning thereby that there will be some employees whose salary would have been increased by at the rate of 3-4 percentage, or there will be some employees whose salary would have increased by 0.5 or 0.4 percentage, right? There will be mix and match of everything, right? So that's the reason average is coming as 1.23. So this can also be probable reason of dissatisfaction, that since some employees have got higher raise and some employees have got lower raise. Okay, Vishaka, you just need to analyze it. These are the 4 bases on which you have to analyze it. Okay, answer can differ from a student to a student. Okay, but you have to apply logic and write. Okay, but these are the 4 bases or the parameters on which you have to write your answer. Understand, Vishaka? Okay, now salary is this I already discussed. Now employee turnover is increasing by 34 percentage. Why? You know the reason. This is because of see these 2 reasons, the carry forward reason of that, right? A carry forward reason, and also it is because of this we can see that in the market the rate is 14.1 and our rate is 18.7. It means the employees might be getting better salary in the market, right? Better salary in the market. right? And sick day is increasing by 133%. Why? Because the employees are dissatisfied. They don't like coming to office. They don't like the workplace environment. Okay, they don't like the workplace environment. They might be the case. Okay, and that's the reason why they are leaving the company as well. That's the reason why they are leaving the company as well. Okay, so this is how you have to analyze it. This is how you have to analyze it. Okay, is it clear, everyone? The answer will differ, guys, as there is no proper format for it. There is no proper format. You have to analyze things, and when you have to analyze, there is no proper format. But yes, you have to give proper headings and analyze according to what you think is correct. Okay, might be a case that different students will give different reason for increase or decrease. Okay, and that is also justified. Till the time you are able to justify your point, it's fine. It's correct. It's correct. One of the probable justification can be the case that this increase in revenue, it might be due to the technological advancements, and not due to salary, not due to employees. Okay. Now coming to topic number 3, guys. Framework. Guys, understand, framework is a topic which I believe that you should read on your own. Okay. But yes, understand the approach. First approach should be read it once. Okay. Then always compare. Always try to compare this with the IAS and the IFRS. Okay. There will be situations where the framework will be in line with the IAS, where the framework will be in line with the IFRS or IAS or IFRS, and there will be situations where the framework will be in conflict with the IAS or IFRS. Okay, you have to analyze it. If you are not able to analyze it, fine. Whatever, read the questions, and whatever are the conflicts and the similarity which you get in the questions, make a list of it, and just at least keep those in your points. Okay, at least keep those as a pointer ready for you. Now, you have to identify the conflicts. And similarities. Both. And don't need to by heart it. Don't learn it. Understand it. Why? Understand. Because the framework will give you a definition of asset, liability, income, expenses, equity, right? And the relevant standards will also give you the definition for a asset, liability, income, expense, or equity. Analyze what's the difference. Framework will give you measurement basis. The standard will also give you measurement basis. Let me give you one example for both. Similarity. What is the meaning of equity? As per framework? Residual interest in the net assets of the entity after paying off its liabilities. See, come to financial instruments. What is the meaning of equity? Residual interest in the net assets of the entity after paying off its liabilities. Similarity. Let me give you one conflict also. Inventory has to be measured at net realizable value, but measurement basis given in framework says historical cost, or you can say value in use, right? All these things it says, fair value it says, right? So it might conflict also. It might be conflicting as well. But now, whenever it conflicts, understand, the local laws is more prevalent. If local laws and IAS conflicts, law will win. If law and IF framework conflicts, IAS will win. Sorry, if IAS and framework conflicts, IAS will win. So framework is the last person. Is it clear, everyone? Now, but still, if you guys have any queries, definitely you can reach out to me. Okay, and I will try to resolve it off. Now, the rest. What is the rest? See, I have not covered these standards in your classes. Borrowing costs, I have not covered government grants, I have not covered non-current assets held for sale, I have not covered provisions and events after reporting date, I have not covered biological assets, for which the video link I will give in the description box. Siddhant, I don't have any list for this, okay? You have to analyze it. If I give you the list, it will be of no use for you, okay? It will be of no use. You will just try to memorize it off, and I don't want you to do that. Okay, now video link will be in the description box of this video. Okay, how much time? See, what I have done here is, it might take not more than an hour to watch all these. It might not take more than an hour, not more than an hour or so, not more than an hour. Okay, So to save your time, I've also given you timestamps. I've also given the timestamp so that you have to watch only from this time to this time. Okay, I will give you the link of the video and I will give you the timestamp that you have to watch from this time to this time. Rest, don't need to watch the full video. Don't watch the full video. It will not make any sense for you. Okay. Study plan. What is the day today, guys? What is the time? What is the date? 28th. And when is your exams? 8th. So what is the time? Tell me what is the how many days? 28th is already over now. Considering 28th is already over. 29, 30 and 7 days there. So 9 days, right? You have 9 days. You have 9 days. You have 9 days. Okay, if there are any important ones, I will definitely come out with that, Siddhant, don't worry. Now 9 days, you have 9 days, okay? So first 4 days, you can focus on the concepts, you can focus on questions, okay? Then the next 5 days, give 3 mocks plus read as much as you can, plus read the answers. Reading will give you better sense. Reading will give you better sense. Okay, read as much as you can. Not workbook. What you have to read? You have to read the answers. See, read the answers means you have to read your practice kit. You have to read your suggested answers. You have to read the you can say this one articles. You have to read article. You have to read examiner report. All these things you have to read. Is it clear, everyone? So that's all for the day, guys. I wish you all the best for your exams. Everyone, all the best, guys, all the best. Give your best. And yes, before at least 2 to 3 hours before the exams, please stop your study. Trust yourself. You have studied very nicely. Trust yourself, and please at least 2 to 3 hours before the exam, stop your studies and let your mind have some relaxation so that it can perform well in the exam. Because this exam is all about analysis. So to do the analysis, your mind should be active. Okay, your mind should be active. That's all for the day, guys. Thank you. Bye bye, guys. Bye bye, everyone.